like to move on to our next exciting workshop. I'd like to introduce our next speakers who will be talking about innovation through social finance, insights on cash flow based lending. Of course, it's based on their very real life experience. And I'd like to introduce Keith Taylor, the Executive Director at the DUCA Impact Lab, and Miss Stephanie Holmes-Winton, the founder and CEO of CacheFlow. Thanks so much for joining us at FFCON20. Over to you, Keith.
Thanks, Craig. It's a pleasure to be here. Thanks for having us. I'm excited to talk to you a bit about a really unique approach that we've been utilizing at DUCA through the Impact Lab for about a year and a bit now. And we've been working with fintechs like CacheFlo and with entrepreneurs like Stephanie Holmes-Winton, who's I'm very fortunate to have on the session with me today, to really solve inequities in the banking system. As a credit union and one of the fastest growing credit unions in Canada, we've really had an opportunity to see firsthand how parts of the financial system work really well, especially for middle income and lower income folks, and some don't. And you know, the opportunity to participate in the financial system is hugely important if you're able to create stability and move forward with your own lives. So it's huge implications to the middle class, and we thought what we wanted to do in recognition of some of those gaps was really to create some space to play with some solutions. And while I think that was socially driven to begin with, it's actually produced a really unique innovation opportunity for fintech partnerships. I'm sure in your strategies, financial institution partnerships are part of the mix. They can be a really important catalyst for fintech companies as they scale and grow. And what we're able to do through a social finance approach is actually start to build those relationships and to test the use case for the technology and gain some insights on how it could be applied throughout the institution. So social finance, I would think, is a fairly underutilized approach for developing these sorts of partnerships. It can be a really effective one. So what we're going to do today is take you through the at a high level the case for this sort of approach, and also what DUCA has created in the Impact Lab as a vehicle to make these sorts of partnerships happen, but also a really specific example on how we've worked with CacheFlo and Stephanie's team to create some really interesting innovations for both of us. I think they've added pieces to their technology. We've added changes to the way we do things, and it's led to some broader partnership opportunities as well. So we're going to take you through that as an example and give you some opportunities to get involved with this sort of approach, should it be of interest. So without further ado, as I was mentioning, I think collaboration on social goals is a really unique way and a very good way to get to know each other, whether it be on the fintech side or the financial institution. On the fintech side, you have a situation where through these partnerships, you have a really unique opportunity to build new applications and use cases for your technology. You get an opportunity to test and collect data and expand your risk frameworks on demographics that you probably wouldn't have pursued otherwise, at what it turns out to be, very limited or zero financial risk to the fintech. And it also lowers your cost of capital. If you're involved in lending at all and lending through procured VC funds or funds from private investors, sometimes bringing that cost of capital down can be difficult. It's just it is what it is. But through this type of partnership, we're able to access a lower cost of capital and test demand at a bit of a different price point, which is quite interesting. And we're able to apply the learning from these social finance partnerships to other channels in the FI, which is a great partnership opportunity moving forward and creates some additional value for both organizations. From a financial institution side, the current environment is really heightened the importance of openness to innovation. Broadly speaking, you have all these moving parts happen. The landscape's shifting very rapidly, and And the kind of backdrop of all that is things like open banking and an increased digital presence is coming down the pipe. And it's, I think, particularly for mid-size financial institutions, there's a real opportunity to partner on collaborative approaches with the fintech community. So it creates strategic value. It helps financial institutions evaluate risk in these sorts of specialized lending portfolios, and it tests the potential of new models and the viability of expanding service offerings and product portfolios for financial institutions. So all very important goals and boxes to check on both sides of the ledger here, and it's why these types of partnerships make so much sense. So another backdrop piece that really necessitates this sort of approach has been COVID-19. It's really changed a lot in terms of how we offer service, how we run as businesses, and as I'm sure it has for everyone on the call. Before COVID-19, I think it's important to highlight that the broader financial health status of Canadians in particular was not the best. There's a litany of reports on the financial status of the average Canadian consumer going into the pandemic. My favorite one to reference is one done by the OECD, which evaluates household debt as a percentage of GDP. And that report, Canada actually led the world, at least the developed economy world, in terms of household debt. So if you take a group of people that had debt loads like that and then put them in a situation where incomes are disrupted, where all sorts of financial constraints are being put on a lot of people, then you have a situation where financial health, looking down the road, becomes a real big part of the risk framework for financial institutions and for fintechs. We get reports from Angus Reid just evaluating perceptions of the COVID-19 pandemic and the impact it's having on people's lives. And one of the things that comes up consistently in that report is a significant level of anxiety around what this is going to mean for financial health for the average consumer moving forward. We also kind of couple that with some observations coming from the CBA and the credit union associations, which are similar, and that like 14% of mortgages have been deferred, and that's not including other types of loans, and it's not including, and that's really just a point in time. I think what will matter to financial institutions is when it comes time to turn on those payments again, how likely are incomes to return to pre-pandemic levels, and on what timeline will start to become really important factors in financial modeling moving forward and risk frameworks moving forward for anyone that's involved in lending. So financial health is about to become really important for everyone in the ecosystem. One area that's not particularly well understood is the role of the relationship between lenders and consumers. And we do a lot of exploration on this particular topic in the Impact Lab. And I think what you can take away at a high level is that there's a radical difference between people's ability or people's opinion to assess their ability to manage their own finances and their perceived ability on the lender's side. So what I mean by that is lenders are doubtful that people are making the right decisions or even understand the decisions that they're making, but the people making the decisions, the consumers, are very, very confident in terms of the choices they're making. And that's an interesting little dichotomy to point out. I think it's it really deserves a lot more unpacking, and there's a lot of power dynamics at play there as well to deserve a lot more unpacking. But really what it gets us to is the start of a recognition of a need for lending models and models of service in financial services that are based more on behavior and and more of a reflection on how people actually manage their finances, and less of a math exercise. And what we're going to do is get into an example, and you'll see how that works when we start to talk about the escalator loan pilot we're doing with CacheFlow. Oops, wrong way. So that ties directly into why the Impact Lab exists, is that behavioral, tangible, real-world approach to providing capital in such a way that that actually drives better outcomes for everyone. So the Impact Lab is a really unique structure. I don't think there's another organization quite like it in Canada. It was established by DUCA Credit Union. If you aren't familiar with DUCA, DUCA is one of the larger credit unions in Ontario, and one of the fastest growing credit unions in Canada in recent years. The story of DUCA is really interesting. It was actually established by a group of newcomers to Canada that couldn't get access to banking services. And they couldn't get access to banking services because they weren't able to send the right signals to the banks that they'd be good banking customers. So what's interesting about that is that, you know, if you take that group of people who are on paper were not supposed to be good banking customers, and you look at the profit trajectory of DUCA and the growth trajectory of DUCA over the last 67 years, and what you'd see is that an annualized growth rate of 27% a year for 67 straight years was built on the business of serving people who weren't supposed to be very good banking customers. So that tells you, you know, that's kind of a cool growth story, but what it also tells you is that the signals used to access credit are imperfect. And the fact that DUCA exists and is one of the fastest growing credit unions in Canada is proof of that statement. So we wanted to unpack that some more, and we wanted to create some space. Like, if the signals are imperfect, then we need some better signals. And if we need some better signals, how are we going to get there? How are we going to create some space to play with what better signals might be possible? And what we arrived at was the Impact Lab structure. So the Impact Lab is a nonprofit innovation hub established by DUCA Credit Union. And we structured it as a nonprofit because we want to stay true to the mission of really just figuring out what banking would look like if all we were trying to do was solve a problem or create an opportunity. We didn't want to worry about earning hurdle rates at 3 months at a time. What we really wanted to do was create some innovative models and assess the risk so that we could figure out how they should be scaled. And that could be scaled as a for-profit, traditional for-profit structure, because scaled under as a social enterprise. It could be scaled as a charity. It could be scaled within the financial institution. It could be scaled. It might not be scaled at all. It could just be taking some learnings and moving on. So it's a really unique structure, and the way partnerships work in the Impact Lab is that they tend to, our role is really as a collab, as making the link between the community sector and the social finance sector and the fintech sector, whereas we're kind of the intermediary as a financial institution in the middle, and it's created some really unique opportunities to work with sectors that don't often collaborate with each other. So the escalator loan pilot is an example of how that could work, but I think yes, okay. So sorry, I may have shuffled my slides around unintentionally, but the way that you can get involved as a fintech in the Impact Lab are kind of multifaceted. We tend to take the approach when we deal with our fintech partners of, you know, a fairly active courtship before we jump into the relationship. And what that generally tends to mean is that we host a series of design-based sandbox events where we tackle a particular issue related to equity in the banking system that we see happening, that we want to create solutions for. So it's very design focused. It's an invite-only session, so it's not you know, hundreds of people. Usually we kind of keep it to a couple dozen, and they're coming from all over. They're all over, you know, different stakeholder groups in the banking system. So there'll be some people there from related community groups. There'll be people there from the banking side of things. There'll be people there from the legal and regulatory side of things, and there'll be people from the fintech community. And what they do is we have a facilitated sessions that seek to create, a skeleton model of how we might solve these issues, with the intention of using those models as a way of developing pilot initiatives within the Impact Lab. So we'd love to have more and broader fintech participation in those events, and those events generally tend to lead to the more successful ones. Tend to lead to longer term partnerships. We work with fintechs, a small number of fintechs, over a very long period of time. So we're not like a traditional incubator where we offer up some general supports and some office space and some networking help. What we do is we work as a partner on these little initiatives. And when I say little initiatives, like we're kind of starting these partnership-based businesses almost to see how they run, to see what the risk is, and to see what we can learn in the process so that we can figure out how to scale them. There's a number of ways to work with the Impact Lab. If you're interested at all, my contact number and email is at the end of the presentation. Love to hear from anyone involved in this conference, and I think we can have a conversation and go from there. So to get to the specifics of this particular partnership, which has been a great journey and wonderful learning opportunity, is one of the things we want to tackle when we started the Impact Lab was a better solution for people that were in trouble with high cost debt. So this could mean payday loans. It could also mean different types of predatory consolidation loans that you often see. It could potentially mean credit cards. It could be really anything where lenders have extended too much credit under very unfavorable terms, and it's trapping people in a cycle of just trying to keep their head above water to pay those debts off. So we figured there's a better way of doing this, and that the risk of doing a lot of this lending probably wasn't as high as the 400% APRs that payday loan companies charge, and that we want to create a better way. So what we did was we created something called the Escalator Loan Pilots, a collaboration between DUCA, the credit union, the Impact Lab, Cashflow, Credit Canada, and Equifax. And it's a loan consolidation product that is completely based on cash flow analysis through the Cashflow program. So it doesn't consider credit scores. It doesn't consider traditional debt service metrics. It just considers, what does your cash flow look like, and what kind of room do you have to make a debt payment and still move forward with fostering better financial health. It's got a number of different elements to it that are pretty innovative. I think one is that in addition to that cash flow based lending model, the pricing model is one that it's a fairly low cost to begin with, but it actually rebates borrowers for exhibiting the right behavior, making their loan payments on time. It starts off as a prime +2 loan. And as a borrower, if you do what you say you're going to do and make all your payments on time, you actually get rebated the +2. So it becomes a prime rate loan, if you're a good borrower. And the reason for that is we often in the financial sector view interest rates as an indication of risk, and that's the explanation that is often given, and I think that's the way people generally tend to approach pricing. But if someone pays back their loan, another way to look at that is that when you assign an interest rate to a borrower, you're essentially making an educated guess on how risky that individual is going to be as a borrower. If that borrower shows no issues, makes their payments on time, does everything they say they're going to do, then your guess was wrong. You have overestimated the risk that borrower is bringing to the table, and you should rebate some of that money. You should bring it down to a level that is more fair and in line with the actual risk of dealing with that particular borrower. So, having said that as a starting point, I'm going to turn it over to Stephanie Holmes-Winton, who is the founder and CEO of Cashflow. Right after I go through the slide, so to give you an example of the of the sample that we're working with in the pilot is it's a very high risk sample. Their household incomes are moderate. They're not necessarily low income, but moderate income. But credit scores are sub 600. They are generally in some sort of cash flow crunch related to high cost debt. And I think under traditional adjudication process would be considered higher risk. What we're learning through the data collection is that the risk isn't quite as high as we might have guessed. There's been 0 defaults. We've restructured 10% of the loans so far, and 20% of the loans are experiencing COVID-19 related difficulties. So COVID-19 has certainly thrown a wrench in the pilot, but that does mean, all that means is that we have to extend the pilot a little bit farther to create the data set that we need. What we are finding is that people are willing to share that cash flow data with us via the Cashflow program. We have 70% of our people that have kind of come into the program through Credit Canada have completed a cash flow analysis and a cash flow program. So go forward with a loan or not, they have that plan to help guide their decision making financially. And of the people that completed that cash flow plan, we're able to extend credit to about 71% of them. So a really high level of participation in once they get through the process of sharing their data with us in the actual loan program. So now I will kick it over to Stephanie Holmes-Winton. Stephanie's been a key collaborator in the pilot. I don't think it would have gone as far as it has without her important contributions. And Cashflow is a really unique platform for and behavior-based platform, I think, is the most important thing to say, and very much linked to how people actually make decisions and spend their money. And it's been a great partnership, and their Cashflow platform has been a really useful tool for this particular type of lending. So having said that, I'll turn it over to Steph, and she'll explain a little bit more how the cash flow side of this pilot works.
Perfect. Thanks, Keith. Hi, everyone. So with our tool, Wynton, which is what you can see here, that's the client app. So that's the tool that an individual uses to submit their cash flow profile. But it doesn't just serve to help us analyze their data. It also gives them some advice back. So one of the things we're looking at is the difference between the types of expenses that somebody has that are high risk and the types of expenses that they have that are low risk, which I'm going to talk a little bit more about in the next slide. So we'll just get to that in a second. But this app is not only helping us analyze what is going on, but it's allowing us to send advice back to them. A lot of people, regardless of their credit score, borrow and have debt and have never been sat down with or given any tools to help them manage it. So it is no wonder that we have some of the scenarios that we do. So if we're going to work with credit challenged individuals and help them find solutions, what we did is we packaged in that spending advice and not just analysis and determining whether somebody is suitable. So I'll get you to go to the next slide, Keith. Perfect, some buckets. So one of the ways we look at the expenses, which makes it easier for the Credit Canada counselors to look at the information. And we have a linked tool that has a professional dashboard, a back office, if you will. So when somebody submits their information in through Wynton, through the app, the Credit Canada counselor can actually review that data, but we put a filter on it to make it easier for everyone. And we look at the expenses that are very low risk and very easy for us to trust that the information that the individual put in is accurate. Not because we wouldn't trust them to be accurate or to be honest, but that the data in the expenses that are more high risk on that yellow bucket, the spendable expenses, are very difficult for people to verify. But we know that these commendable or committed expenses are very predictable, very easy to find. There's only a couple of transactions a month. And then what our app is doing is it actually doesn't need a lot of that data on the spendable side because it's going to recommend how much is safe for that person to spend based on their financial profile. And in doing that, we can actually discern what they can afford to pay back. And that is the key here, is to figure out not what someone qualifies for based on a credit score, which unfortunately still too many people don't understand. So some people have poorer credit because they don't actually know what to change or what to do. But when it comes to this process, what we're trying to figure out is, can you really pay it back? And let's not loan you enough money to hurt you. Let's loan you just enough money to help you, and then give you a spending plan to make it easier for you to stay on track. So speaking of that spending plan, I'll get you to go to the next slide, Keith. Awesome. So this is the last thing that we do. So first we do an analysis and we recommend that spendable number. And then we teach the person that gets the escalator loan to make a change to their environment. Most of the time when we get a new loan or we try to change our spending habits, our financial environment looks like this. And it usually still looks like this after we made all the supposed changes. And that's where our income goes into the bank. It goes out through unconscious expenses. We pay our bills, we pay our debts. There's too much month at the end of the money, so we use our debts to pay our bills and spend unconsciously. And around in a circle we go, and no wonder so many Canadians do not have enough in savings. This is a setup for disaster. If we don't change the environment, no matter what advice or loan we give anyone, the ability to actually make a change is going to cause them to be in a constant white knuckle situation where they have to be conscious all the time. And humans are not good at that. So if we look at the next slide, you'll see the change in environment. And so this is a behavior-based system using the data from Wynton, that recommended safe to spend, that spendable number. DUCA Credit Union backs us up by providing a free spendable account. And all this really is any kind of inexpensive or no fee, low fee checking account where that individual can automatically transfer the recommended amount from their regular bank account, which now only has their committed expenses coming out, into that spendable account. Then they only focus all of their energy on managing the spendable account, leaving the money actually available to pay the escalator loan, to save a little bit. And then with the added benefit of the escalator loan, if they're successful, and I believe we have a few people on track that will be getting some interest back soon, if they're successful, then they're going to get a bump in that committed account, which can go towards savings. So we're going to have people who come in with not the best credit and who don't look good on paper, figure out a way to lend them enough money to help them, not hurt them, give them a way to improve themselves financially. And then when they do a good job, we're going to give them some of the interest back. So it's a very fair thing. So Keith, do you want to talk just a little bit about how the loan itself is designed?
Yes. So the loan itself is meant to be a really accessible source of financing for folks that wouldn't really be able to access consolidation loans under these types of terms. So it's people with lower credit, people with moderate incomes, but probably not a high income borrower, and it's priced in such a way that even if they fall behind and they don't qualify for that rebate I mentioned earlier, they are still able to get a really fairly priced loan that doesn't have a lot of punitive fees attached to it, that can be paid off at any time. And has some degree of flexibility in terms of the repayment. Is very much linked to their cash flow. So the pricing is prime plus 2. It's completely structured towards the realities of that individual's cash flow, and the terms can be a little bit flexible as cash flows change. We've definitely seen in the COVID-19 pandemic over the past few months. And it's ultimately designed to lift people out of that cycle. When you're at a payday loan, the entire principal balance of that loan is due in 2 weeks. And for most people, that has a run-on effect to the rest of their cash flow. If you have to essentially take a couple $1,000 out of your paycheck, you're going to feel that in the next pay period. So it's meant to help people move out of that situation in a way that doesn't impose on the rest of their financial plan.
Yeah, it gives them just enough to help and not enough to hurt, so we don't trap them in this cycle. So if you can go to the next slide, Keith. The way we've actually set this up is we've created a landing page, for lack of a better term, a sign-up page, where an individual can actually go and learn about how the escalator loan works. They can then submit their information to Wynton by signing up, and that will send them an email, allow them to log in securely. But what it's also doing is there will be people who don't need the loan once they figure out what their committed and spendable is. So even those who don't necessarily get or need a loan can still be helped from that cash flow premise of what Wynton can do on its own. And if you go to the final slide, Keith, the final slide for me anyway, we have kind of an easy 1, 2, 3 step clearly laid out in that sign up page. So all they have to do is enter their name and email, and then they're walked through entering some high level details, income, debts and expenses, and any assets. And then once they've done that cash flow check, they get a prompt to connect with a credit counselor at Credit Canada. And then they'll take them through the final stretch of applying for the loan. And then Keith will make it happen if we've got somebody who's ready to improve their finances. So that's it for me. I hope that context was helpful.